The RCMP pension plan is one of the best pension plans available in Canada, and today we're going to give you a brief overview of features and benefits and what the pension plan is all about. So it is a defined benefit plan. The plan administrator is Morno Chappelle, and the company that manages the investment portfolio is PSP Investments, Public Service Pension Investments. Portfolio value is $243 billion, so that's the amount of funds invested for various pension members, not just our RCMP, but also other public service workers. And the last line there, the pension plan portfolio, the $243 billion, has averaged 9.2% over the last 10 years per year. So 9.2%, which is a fantastic return, by the way, and this is as of March 31st, 2023. Here's the basic formula on which the pension amount will be based. And essentially, your contributions, obviously, your own and your employer who's matching plus, times years of service, and the actual annuity lifetime pension is based on 5 best years, which generally would be the 5 last years. And what are your options as far as taking your pension? Well, either you take an annuity, or you can also take lump sum value or cash transfer value or transfer value of your pension. And both of these are listed on your annual pension statement that generally goes out in November. So let's start with the annuity. And the annuity, again, it's a lifetime guaranteed monthly income, which also has a survivor's allowance. So if you were to pass on, your spouse would receive half of your pension, plus there's 10% for each child that you might have up to 4 kids. So if you have more than 4 kids, the 10% is payable only for the first 4, and when your kids turn 18, that 10% falls off. Now, the immediate annuity is available after 25 years of service or at the age of 60. So whichever one is first. Now, if we look at the transfer value, the transfer value is only available prior to the age of 60, and you must have less than 20 years of service. So if you have more than 20 years of service, forget about the cash value. You cannot take that anymore. You only have the annuity itself available. So let's look at some case studies and when should you be looking at the annuity and who is most suitable to take the cash transfer value out, what type of a family, and so on. Option number 1 is the annuity. So here is the situation. Jeff is 55 years old, currently 19 years of service. He is married. His spouse is a yoga instructor. Combined RSPs, they have about 100,000 in their RSPs combined. They have started a TFSA, only about 12,000 in TFSA. They do have a principal residence, $500,000, with a mortgage of 350,000. And if Jeff wanted to retire at the age of 60, he would receive lifetime annuity of $45,000 per year, and also a bridge, which is only available until the age of 65. But then at the age of 65, CPP and OAS will kick in at around 21,000 combined CPP OAS. Well, in this case, since the accumulated modest amount of RSPs and TFSAs, they still have a substantial mortgage. They will have a mortgage at the age of 60. In this case, we would recommend definitely looking at the annuity and taking the annuity. Let's look at another case study, and this is a different family. We've got Brian here, age 54, 19 years of service. His spouse is a teacher, and she also has a defined benefit pension. They have RSPs, 250,000 in RSPs, combined TFSAs 185. Their principal residence is $1 million. They have no debt. And Brian plans to retire next year at the age of 55 and before his year 20. Jen, the spouse, the teacher, will take her defined benefit pension plan since she does not have the option to take out cash. She can only take annuity. So in this case, we would be recommending for Brian to at least consider, to at least look at the cash transfer value and to see how much better off his family would be taking the cash versus an annuity, since his spouse already has a guaranteed pension income. So one pension is guaranteed, Both of them will qualify for CPP-OAS. They have about $400,000 in investments, and they're completely debt-free. So this is a perfect family candidate to consider the pension cash transfer value. Now, let's say they do decide to take the cash transfer value. This is what will happen. The cash transfer value is an actuarial formula based on age and current interest rate environment. So the lower the interest rates are, the higher the overall lump sum will be. So the lump sums that we are seeing now are slightly or significantly lower than they would have been a year ago or 2 years ago, but we expect interest rates to decrease in the future again. So it's still very, very viable, but it did decrease over the last couple of years or so. But essentially what's going to happen is the cash transfer value will be transferred to a locked-in RSP plus an investment account. If Brian has room available in his RSP, he can move part of the cash into the RSP, and then obviously we would be recommending to top up their TFSAs if there's any room available, and then the remainder of the cash will go into the joint portfolio. Now the biggest thing is that Brian will be able to control all of these funds. He will be able to control income coming out of the portfolio, and these funds will form part of his estate. So should something happen to Brian, all of these funds will go automatically to his wife and then ultimately to his kids. So based on Brian's actual numbers, his cash transfer value is about $830,000. $300,000 will roll over into a locked-in RSP on a tax-free basis. And essentially there's no difference between an RSP and a locked-in RSP, same investment portfolio, same rules, except for the locked-in RSP there's an annual maximum that prevents you from blowing your portfolio in a short time period. So $300,000 will slide over into the locked-in RSP. $530,000 will be taxable. Well, luckily Brian has $40,000 available as far as RSP contribution room. So $40,000 will go directly into his RSP, and $490,000 unfortunately will be fully taxable. So there will be $310,000 after tax available to invest. Age 60, Brian will receive exactly the same income from the locked-in RIF investment portfolio and the RIF as he would have received from the annuity, which is, as I said earlier, $45,000 annually. And the situation at the age of 85 is as follows. If Brian averages 4% on his investment portfolio across all three accounts, age 85 there'll be about $74,000 left in his RIF, and $74,000 in his locked-in RIF, and $57,000 in his RIF, so about $131,000. If he averages 5% total at the age of 85 will be $301,000. If he averages 6% on his portfolio overall, the total age 85 will be $565,000. And if he was averaged 7%, as I said earlier, PSP Investments averages 9.2% on the pension portfolio itself, but at 7%, age 85, the portfolio would be at 842. So we believe 6% is very reasonable, and at 6%, age 85, the same income, there would be about $500,000, actually over $500,000, $565,000 still left over proceeds of the pension transfer. So obviously this is a very, very attractive estate improvement, age 85, over $500,000. So in Brian's case, obviously we did recommend for Brian to take the cash transfer value. Well, here's some comparison between the annuity and the transfer value as far as advantages and disadvantages. Well, obviously with the annuity, the income is guaranteed for the rest of your life, and there is allowance for the survivor, and there is no market risk. So Warner Chappell and PSP Investments are taking all the market risk. You don't have to worry about it at all. Disadvantages of the annuity: there is no estate benefit. So if you were to pass on, there is significant reduction in your spouse's income. No net worth improvement, even though the pension is a very good pension, but again, when you pass on and then ultimately your spouse, the pension or the capital goes back into the pool. And as I mentioned earlier, survivor's benefit is reduced by 50%. So compared to the transfer value or cash transfer value, while the advantages are that there's potential for significantly higher net worth, more flexible income options as far as you can decide if you need more money, you can pull more, or if you are not spending as much as needed, then you can pull less and be in a lower tax bracket potentially. And no reduction in survivor's income should you pass on. Well, the disadvantages are you are taking the market risk fully, because since you're taking the pension out, there is no annuity, all of the risk is with you. You must average at least 4% to be better off than staying in. And, well, now you're managing your own portfolio or you're hiring an advisor, somebody like myself. Well, thanks for tuning in today. This is our planning process. If anybody's interested in, looking at what the cash transfer value would look like versus keeping the annuity, or if you're just planning your retirement, we use the financial planning software in which we can model pretty much any type of a situation. And this is our process. We do a full review, portfolio review, taxation, cash flow, specific to your own family. Feel free to reach out via email or phone call. My information is below, and we'd be happy to meet anywhere in Canada virtually, or if you happen to be in the Lower Mainland, feel free to stop by the office. We're in the Marine Building, right downtown waterfront. All right, please like the channel, please subscribe to the channel, and have a good day, everybody.